Hey everyone, welcome back to Corporate Decoder. Today we're diving deep into VistaGen Therapeutics' latest financial report, and let's just say they've been busy but not exactly printing money yet. VistaGen is a biopharmaceutical company working on treatments for neurological disorders, and this report covers their quarterly performance ending June 30th of 2025. We're going to look at their financials, their risks, and what this all means for their future. If you like getting straight facts and straight talking about company finances, make sure you're subscribed. And hey, we've got a great community discussing these deep dives over on our Discord, so check that link in the description. Let's kick things off by looking at their balance sheet. Think of this as a snapshot of what the company owns and what it owes. As of June 30th, 2025, VistaGen had total assets of about $69 million. That's down from about $84 million back in March. A big chunk of that change comes from their day-to-day cash. They had about $49 million in cash and cash equivalents at the end of June, a pretty significant drop from nearly $67 million in March. This tells us they're spending money and they're spending it faster than they're bringing it in from operations. On the other side of the balance sheet, total liabilities are around $12 million, which is also down slightly. Now, the big story here is often in the stockholders' equity section. This is where we see the company's history of losses. As of June 2025, VistaGen has an accumulated deficit of a whopping $423 million. That's a massive number and shows just how much money they've spent trying to develop their products without much revenue to show for it yet. Now let's move on to the income statement, which really tells us about their performance over a period. For the 3 months ending June 2025, VistaGen brought in just $244,000 in revenue. That's a small increase from $84,000 in revenue. That's a small increase from $84,000 in the same period last year. But here's where the money really goes: research and development. They spent almost $11.7 million on R&D in the recent quarter, a big jump from about $7.6 million in the prior year. This is the core of their business, pushing those drug candidates forward. On top of that, they spent about $4.4 million on general and administrative costs, which is fairly stable compared to last year's $4.6 million. All this spending resulted in a net loss of about $15.1 million for the quarter. That's a substantial loss, and frankly, it's worse than the $10.7 million loss they had during the same quarter last year. So while their revenue is creeping up, their losses are widening, which is a common story for drug development companies. Looking at the changes in stockholders' equity, we see the impact of that net loss again, chipping away at their equity. They also had a small increase in additional paid-in capital due to stock-based compensation and sales under an employee stock purchase plan. The cash flow statement paints a clear picture of their operations. They used about $18.8 million in cash for operating activities during the 3 months ending June 2025. That's a huge outflow compared to the roughly $10.9 million they used in the same period last year. This confirms they are burning through cash at an accelerating rate. In investing activities, they spent about $788,000, mainly on marketable securities. This is a much smaller outflow than the $5.5 million they spent on investing activities last year. Financing activities show they brought in about $1.5 million, mostly from stock sales through their open market sale agreement. That's up from just $88,000 from financing in the previous year. This shows they're actively trying to raise capital to keep the lights on. Now, let's get into the important details buried in the notes. This section is crucial. VistaGen explicitly states there's uncertainty about whether their available cash will be enough to fund operations beyond 12 months from the report's issuance date. They conclude that substantial doubt exists about their ability to continue as a going concern. This is a serious warning sign. It means without more money, they might not be able to stay in business. Here they talk about how they value their assets like cash and securities. They use a 3-tier system based on how easy it is to get a price for something. The great news here is that most of their cash and money market funds are considered level 1, meaning their fair value is based on unadjusted quoted prices in active markets. This is good because it means those values are pretty reliable. Their marketable securities are mostly US Treasury securities, which are generally considered safe, and their value is easily determined. They classified these as level 2, meaning their value comes from observable inputs for similar assets. It's positive that they aren't holding a lot of risky level 3 assets. In May 2025, they took out a $1 million promissory note, mainly for insurance premiums. This is a loan they'll be paying back with interest over the next year. This is an important agreement for them. They have a deal that allows them to sell their stock on the market when they want. As of June 2025, they had about 171 during the recent quarter. They sold about $190,000 worth of stock still available to sell under this agreement. During the recent quarter, they sold about $190,000 worth of stock, bringing in a bit of cash. They have a lot of warrants outstanding, which are like options to buy stock later. Some of these are quite significant in number, like over 9 million with an exercise price of $5.38. The exercise of these could bring in more cash for the company or increase the number of shares outstanding, potentially watering down existing shares if not managed carefully. Here we see how much they spend on compensating employees with stock options. For the 3 months ending June 2025, this expense was about $916,000, compared to $1.16 million in the same period last year. This is a good sign that their stock-based compensation is becoming a smaller part of their overall expenses, which can be positive for existing shareholders. The net loss per share was negative 47 cents for the quarter. This means for every share of common stock, the company lost 47 cents. That's a wider loss than the 35 cents they lost per share in the same quarter last year. This section details their agreements with other companies. They have an agreement with AFAMED for a drug called Fasedienol. AFAMED paid them $5 million up front and could pay a lot more in milestones and royalties if the drug is successful. They recognized about $0.2 million in revenue from this in the recent quarter, up from $0.1 million last year. They also have a negotiation agreement with Fuji Pharma for another drug candidate, PH80. Fuji Pharma paid them $1.5 million for this exclusive negotiation period. So far, though, no revenue has been recognized from this in the recent quarter. This section, known as the MD&A, is management's chance to talk about their business and outlook. This is where they warn about future-oriented statements. They're saying that what they project might not happen, and there are lots of risks involved. It's standard legal talk, but serves as a reminder that the future is uncertain. Here they reiterate their focus on developing treatments for neurological disorders using their pheromone drug candidates. They highlight their lead candidate, Fasedienol, for social anxiety disorder, and mention they expect results from late-stage trials in the coming year. They really emphasize Fasedienol's potential to be the first FDA-approved acute treatment for social anxiety disorder. They are in phase 3 trials, and the previous Palisade-2 trial showed positive results on their main measure of anxiety. They also discuss Atrevin for depression, noting positive data from an earlier trial and that they are planning further US trials. And then there's PH80 for symptoms like hot flashes during menopause. They mention positive results from an exploratory trial in Mexico and are working on getting FDA approval for further US trials. PH15 is for cognitive impairment due to mental fatigue, and they showed positive results in a small pilot study. They are evaluating the next steps for this one. Finally, PH284 is being developed for cancer, cachexia, or wasting syndrome. They saw a positive impact on hunger levels in a trial, but they're still assessing the path forward for this drug too. This is a deeper dive into their financials. They've spent a lot of money, over $342 million, from selling equity plus government grants and other income sources. They saw a small revenue increase, as we noted, but it's still very minimal. It's clear they are not generating significant revenue from sales. The R&D expense increase is largely tied to those phase 3 trials for Fasedienol. They believe this spending is crucial for their future success. G&A expenses are relatively stable, but they do expect them to increase as they hire more people to support their growth and operations as a public company. Interest income has decreased because they're investing less money overall, reflecting that shrinking cash balance we saw earlier. Here's that crucial liquidity point again. They have about $63 million in cash and marketable securities as of June 2025. But remember that going concern warning, they're burning through cash fast. They'll need to raise more money, either selling more stock, taking on debt, or through partnerships. The cash burn from operations is accelerating, as we saw in the cash flow statement. It's nearly double what it was last year. Investing cash outflow decreased because they bought fewer marketable securities compared to last year. They're a smaller reporting company, so they don't have to provide detailed market risk information. This section is about their internal controls. They state that their CEO and CFO have evaluated these controls as of June 30th, 2025 and found them effective. This is important for financial reporting accuracy. VistaGen is facing a lawsuit filed by two shareholders. They claimed the company made misleading statements about clinical trials. VistaGen believes these claims are baseless and plans to fight them vigorously. This adds another layer of risk. This is a long and important section. It lists all the potential bad things that could happen to the company. The biggest risk, as expected, is that their drug trials might fail or be significantly delayed. This would cost them money and time and could stop them from making any revenue. They are very clear about their financial situation. They've lost a ton of money since they started and expect to keep losing money for the foreseeable future. This is the critical point. They have no approved products and no revenue from sales. It's a high risk, high reward situation. Their entire future rests on their drug candidates getting approved and proving effective. If any of them fail, it's a massive setback. They absolutely depend on getting more money to keep going. If they can't raise it, they might have to slow down or even stop their research. They mention they have the ability to issue preferred stock, which could affect existing shareholders. So what's the verdict on VistaGen from this report? On one hand, they are pushing forward with promising drug candidates in areas with significant unmet needs, like social anxiety and depression. The science behind their pheromone approach is intriguing, and some of their earlier trial data looks positive. They haven't been shy about spending money on research and development, which you'd expect from a company in this sector. However, the financial picture is frankly quite concerning. They have a massive accumulated deficit, they are burning through cash at an increasing rate, and most importantly, they have explicitly stated that there is substantial doubt about their ability to continue as a going concern. This means they desperately need more funding and there's no guarantee they'll get it, or on what terms. The lawsuit also adds a significant layer of legal and financial risk. Looking at the numbers, their revenue is peanuts compared to their expenses. The widening net loss and cash burn are red flags that outweigh the slightly better stock-based compensation expense. The fact that they are still heavily reliant on selling stock or pursuing financing to stay afloat is the biggest takeaway. The company's direction seems focused especially on VistaGen for social anxiety, which they believe could be a breakthrough drug, but the path to approval and commercial success is long, expensive, and fraught with failure for pharmaceutical companies, especially in complex areas like neuroscience. They are in a race against time and a race for funding. The key opportunity here is if VistaGen or one of their other candidates truly revolutionizes treatment for these conditions. The risks, however, are numerous. Trial failures, regulatory hurdles, competition, and the ever-present threat of running out of cash. My take is that VistaGen is a higher risk speculative investment. Their scientific potential is there, but the financial realities are stark. They are in a critical phase where upcoming trial results and their ability to secure further funding will be absolutely make or break for their survival and future success. Investors need to be prepared for significant volatility and the possibility of losing their entire investment. Alright, that's our deep dive into VistaGen's latest financial report. What do you think about their chances? Are they on the verge of a breakthrough or just burning cash? Let me know your thoughts in the comments below. If you found this analysis helpful, please hit that like button. It really helps the channel. And don't forget to subscribe for more corporate breakdowns. We also have a growing community discussing these reports over on our Discord, so join us there. Thanks for watching and we'll see you in the next video.